Thank you, Prabhu, for the introduction, and good morning, all. Thank you for joining on the Saturday morning. So just a quick disclaimer before starting the webinar that whatever the stock ideas that me and my colleague will be discussing, so it's just for the educational purpose, and do your own research before investing on those ideas and themes. So just to lay out what all topics we'll be covering today. So first I'll be covering about the macroeconomic themes, events that has happened in the past and has impacted the Indian market. Then I'll also be discussing about some of the alpha opportunities that we can have because of those macro events. And then my colleague Vijay will be discussing about the key investment themes for next 3 to 5 years. And then he will also be discussing about the case study on one of the portfolio stocks and how the investors can leverage that investing idea. So starting with Prabhu, if you can just move to the next slide, please. So the beginning of the August month was a very volatile one, and there were some 3-4 key triggers in the market that has impacted the market returns. So we got few queries from the client side also, what does it make sense to invest concerning the backdrop of such events. So I just wanted to highlight that these 2-3 events that impacted the market. The first was mainly the correction in the US markets, which was triggered by the jobless claim data. So there was this isolated data point where the number of jobless claims in the US market has gone up above the estimates that was there, and that has triggered it triggered a selling in the US market and across the globally also, and it was because that there was a fear that it might lead to a recessionary event in the future. So, but very recently, just 2 days back, the US GDP print has come in, and it was at around 3%, which was way higher than what we have seen in the first quarter of 1.4%. So, US GDP growing at 3% negates all the belief that the US is getting into a recession anytime soon. And at max, what we can factor in is a soft landing in the US markets. So that's not a trigger for us to do any sort of rebalancing or some sort of changes in the portfolio. And again, the rate cut is around the corner. The Jerome Powell, the Fed chairman, has highlighted that we'll be going for a rate cut for sure in the month of September. So the rate cut is around the corner, and the rate cut will again provide some bit of support to the US economic growth. So we at max we factor in a soft landing for the US markets, and we don't see. And again, if you look at the all the chatters around the market recession, so that's there for around 1.5 years now. In the same time frame, the mid-cap index has doubled since then, right? So there is an opportunity cost which is there if we take a preemptive position into the market and take a cash call basis that. So what we are doing, we are currently watching the data points, but we are not doing any sort of changes in the portfolio currently basis any sort of incoming update from the US markets. The second was the Israel-Hamas war. So that was expected to escalate the tension in the Middle East, and again, oil was expected to go higher. But what we believe that the OPEC is not going to do any sort of things to, and will try to keep the oil or crude under control, so that there is no as such pressure on the global markets, and it derail the growth prospect of the global market. So we don't see as a material event impacting the market. In fact, the best predictor for a market or the economy to do in future is the stock market of that country, right? So if you look at the Israeli market today, it's currently at all-time high, which again negates any sort of negative biases that's coming from the Israel-Hamas war and Israel-Lebanon conflict. So the market is already looking beyond that and trying to factor in the growth prospect. The third was the yen carry trade unwinding. So it was not an again isolated event that has happened thrice in last 5 years, and we expect that that to have a very little impact on the markets going forward. In fact, in just 1 or 2 days of unwinding, the total yen carry trade position in the Indian market got unwinded by 65-70%. So most of the unwinding is behind us, and in very recently when it happened in last year in December, so we didn't see material impact on the market. So it's just that it was a confluence of 3-4 factors that led to a sharp volatility in the market. But in isolation, these factors don't have a much important role to play going forward. So what we do instead, we'll try to find out some suitable long-term sustainable growth stories, and we'll be watchful of the earnings from those segments and sectors going forward to keep track of the market. Now the second point that we get from our customers is that the market is at all-time high. So does it make sense to invest at this point of time? So we have done a study on the markets, and if you look at the last 45 years of data, Prabhu, you can just move to the next slide, please. Yeah. So since 1979, there are there were around 10 bull markets previously, and we are currently into the 11th bull market. And if we compare the current bull market with the previous bull market, so yes, it's a super bull market that we are currently in, considering the kind of gains that we have seen in the market for the duration that we are currently into the markets. For example, currently it's the 54th month that will be entering of this bull market, right? If you don't count the correction phase of 2022. So since 2020, it's a 54th month of the bull market that will be entering into. And if we compare that to the previous bull market of 2003 to 2008, so it was of 56 months, right? So in the duration, we are at somewhat the same level. But if we compare the quantum of return that we have made in this bull market, so it's actually way lower than what we have seen in the previous super bull cycles, right? So it's not even 1/3 of the return that we have seen in the previous cycle. For example, between May 23 to January 2008, 2003 to January 2008, the index has gone up by 622%. But currently we are just in the 4 or 5 year time frame, 4.5 year time frame, the index has just gone up by 220%. And in fact, if you compare the quantum of return or the CAGR return that we have seen in the March 1991 to April 1992, so there in a very short span of 13 months, the market has gone up by 380%, or it has gone up by 4x. So if we compare the CAGR return of this bull cycle, it's way more sustainable than what we have seen in the previous bull cycle. That's why we believe that this bull market could be way longer than what we have seen in the previously, right? So if we look at the kind of changes that has happened in the companies post COVID, right? So the companies have become operationally efficient, right? If you look at the ROE, ROC numbers, that has gone up significantly higher. If you look at the broader market participation in the economy, so that has also improved. And if you look at the leverage levels that is taken by the companies today versus that 2003 to 2008 cycle, so we are way below than the previous cycle of the leverage that we have taken. So all those factors combined plus the financialization of savings, right? So that's keeping the market premium intact, that's keeping the valuation intact, and there's a good support from the earning side. For example, between 2003 to 2008, the index has compounded by 53%, but the earnings growth was roughly in the range of 89 to 20%. But this time we have a index CAGR growth of 30%, but the index earnings compounding is also in the range of 19 to 21%, depending on the index. So the earnings are supporting the market in a big way. That's why we'll be seeing more sustainable rally this time, and it will be an elongated bull market, albeit the quantum of return or the CAGR of return will be reasonable going forward. Now moving on. So there is again one more point to ponder, right? So normally what we have seen is that the earnings growth is like more in line with the GDP growth. So if we look at the Sensex growth of the last 45 years data, it is compounded by let's say 12.5%. That's what the GDP growth also what we have delivered, right? But going forward, the kind of GDP growth that we have seen in the last 65, 75 years, so that is going to double in the next 4 or 5 years. What it means is that like every 3 to 4 year will be adding 1.5 to 2 trillion dollars to the economy. It means every year we'll be adding 400 to 600 billion dollars. And for a company with a market cap of less than 10,000 crore, it's a very huge opportunity. So how we are playing this theme, and we know that since the economy is going to do be 2x, 2.5x in the next 10 years, so we are actually finding out the opportunities from the corners of the country. Let's say we have identified a jewelry business from the eastern part of the country, or a retail from Bihar, a retail franchisee retail channel from the Bihar, which is doing exceptional growth, and also expanding to the near market. Very recently, we have all onboarded a fashion retail company on which Vijay will be discussing in detail later on. But this is how one can leverage that. Once we know that every year we'll be adding 400 to 600 billion dollars to the economy, so we can look to identify the small and mid cap names which are very localized in nature and which have good hold and presence in their domestic market or their localized markets, and we can look to get benefit because of that. So that's one of the way. The other is if you look at Prabhu, if you can just move to the next slide, please. Yeah, if you look at how the different economies has behaved once they have crossed the critical market cap threshold of $2,000 GDP per USD per capita income. So the China has done it in the period of 2006 to 2016 when it has first crossed the 2000 USD per capita mark. And since then, the GDP grew by 3.5x for the Chinese market. The similar thing has happened with the this Indonesian market when it crossed the GDP USD per capita mark in 2008. And since then, the economy grew by 3x, approximately 3x in the next 10-year time frame. So what we are seeing between 2001 to 2013, we'll see similar sort of growth in the economy where the GDP will be growing 3x. So we'll roughly at around, let's say, $8 to $9 trillion of the economy that will be having. So that will be supported mainly because of this key shift in the higher per capita income that will be governing. And that will translate into a 12 to 14% kind of growth rate for the economy, and which will again open up a lot of avenues in terms of investments, consumptions, and all those things. So Prabhu, you can just move to the next slide. So again, this $2,000 per capita mark we have highlighted in the previous webinar also, that's just very important for economy because it leads to some bit of sustainability on the market. And that sustainability, surety of the earnings also translates into the higher premium of the market that we are currently witnessing for India today. In fact, if we compare the growth rate economy goes through, like the market growth versus the GDP growth rate. So always there is a alpha of market growth versus the GDP growth rate whenever the countries cross this 2000 GDP USD per capita income. So for example, for Chinese market, the GDP grew by 13%, but the stock market compounded by more than 15%. Similarly, for the Indonesia, between a period of 2008 to 18, when the GDP grew by 10.6%, the market growth was actually doubled to 20.5%. And in the first three years for the Indian market, also we have witnessed the same thing. Our GDP has grown by 14% post-COVID. But if we look at the NSE 500 returns, it is around 19.3%. So obviously, the most of the return was front-ended, but we continue to expect the market to compound at the rate of 15 to 17%, and the individual story is to compound at even higher pace. So today the economy is growing at a rate of 12.5%, right? And the large cap companies or the mid cap companies are growing at a rate of somewhere between 15 to 18%. It's not difficult to highlight those. But since we have a listed universe of 5,000 and more companies, it's easier for an investor if it tries to dig a bit deeper into that to identify and find out the companies where the growth rate is in excess of 20%. So the super value portfolio that we have created is comprising of such stocks where the growth rate of all the holdings at the point of buying the stocks in the portfolio is in excess of 20%, and that's how we are building and running the portfolio. And in fact, our returns in the portfolio side is actually similar to what 25 to 30% kind of growth, the earnings growth that is delivered by the earnings. So that's a similar sort of return the portfolio has also generated. Prabhu, if you can just move to the next slide, please. So now let's just understand some of the alpha opportunities that we can find in the current market. So the yen denominated flows into the Indian equities, just the outflow was a key trigger for the market to move from the quality to from non-quality to the quality part, right? For example, just to have a look at how this yen denominated flows has participated in the Indian markets. So between 2016 to 18, there was an increase in the flow of yen denominated the investments. And because of that, if you look at 17 was a very roaring bull market. And in that period, there were a lot of companies which has broken balance sheet, those are poorly governed companies. So that has gone up to make multi-bagger returns. But since the quality of returns was not there and the quality of company was not there, so once the bull market get over, so the companies came crashing down by 15 to 70% in the bear phase. And after that, there was an era of quality between 2018 to 2022, when there was outflow of the yen denominated flows from the Indian markets. And then the quality companies having ROE, ROC of more than 15% and the profit growth over longer time frame of 8 to 12% or higher have performed and participated in the rally. So and then after that, there was a change and shift in the stance again, and then again the yen denominated flows started finding its way back into the Indian markets, and again we have seen the cyclicals and the PSU names and the turnaround stories to again go and make new all-time highs, and the quality take a backseat. But since that since now we have started seeing just this month itself that the yen denominated flows are going out of the Indian market. So that could be a good trigger for someone to start building a portfolio of quality and growth oriented stocks, right? So just to understand how the quality and growth has performed in the past, probably if you can just move to the next slide, please. So if you look at the last 10-year data of the quality and growth, how it has participated. So quality and growth oriented companies have delivered around 30% return, while like the companies which are like turnaround companies or cyclical or more of a momentum oriented companies. So in the 10-year period, these companies have delivered a return of 17% CAGR. But if you look at the last 3-year and 1-year return, so obviously like the companies where like the fundamentals are not supportive of long-term earnings growth have outperformed the quality and growth oriented companies. And in the last 1 year, in fact, like the poorly managed companies have actually outperformed the quality and growth companies by a huge margin. So this is a trigger for someone to look for building a quality and growth oriented companies in the future. And in fact, this rate cut is around the corner, and rate cut is very supportive of growth and quality names. So again, this is the segment, since it has underperformed in the last 3 years, so that can come back into the picture and can participate and in the alpha creation in a meaningful way going forward. Now, Prabhu, can you if you just move to the next slide, please. Now, the other section of the market where there are a lot of alpha opportunities, but again, it's a segment which is very treacherous, right? So the small cap index has compounded the investors' wealth by 16 to 18% in the last 10 years. But if you look at the top quartile return, so that takes away the majority of the share. So the top quartile return is roughly around 36%. But if you look at the bottom quartile return, or the return except the top quartile, the bottom 75% of the company's return that it has delivered in the last 10 years, it's nothing. It's actually 2%, right? So if someone is really looking to do its work and try to dig deeper and try to find out the bottom of story, so small caps and mid caps is a very good hunting ground for them, and the reward is in line with it, the hard work you are doing. So the compounding could be in excess of 30%, 36%. In fact, the PMS that we run, super value, it has also compounded in investor wealth in the range of 30 to 35% depending on the time frame, which is in line with the top quartile average performance of the small caps. But this is again a very good segment to start looking for ideas where you can look for sustainable earnings to grow to compound the earnings for a meaningful longer period of time frame. Now, if you can just move to the next slide, Prabhu. Prabhu, if you can just move to the next slide. Yeah. And then there are a lot of sectors and industries which are supported by government initiatives. So, for example, government has done a lot of work in making the manufacturing accessible, and then it has made the companies to do the business easier. And then there are a lot of thrust on increasing the manufacturing and improving the logistics cost and all into the economy. So, for example, PLI scheme is one sector where it was quite beneficial for a lot of companies into the economy. And we played this theme through Dixon, and very recently, around 1.5 2 years back, we exited the company, and then after that, we onboarded some other names which are going to get benefit of it because of it. So PLI focused manufacturing themes could be one of the plays where investor can look for finding out the alpha opportunities. The other is the PM Gati Shakti and Master Plan, right, which is promoted by the government. So if you look at today, the logistics cost in the country is roughly around 16%, which is way higher. If you compare that to the developed market, it is roughly around 8 to 9%. So the government is trying to bring the logistics cost as a GDP, as a percent of GDP, from 16% to, let's say, 8 or 10% or 12%. So that's again a very good initiative from the government side, and there are a lot of companies which can get benefited because of that. So we are playing this theme through the wire and cable space, and wire and cable companies are expected to compound the investors' wealth at a rate of 16-17% for the next decade. We are holding two wires and cables companies in the portfolio that has done wonderfully, that has delivered phenomenal return for us. In fact, one of the company from the wire and cable space that we have been holding for 5 years now has delivered around 12x return, and we are confident that it will be delivering 25x return for us as well. Right. So this is one of the theme that an investor can look to onboard in the portfolio. The other could be roads and railways. So the roads and railways is the key focus area for the government. If you compare the starting point in 2010, we were doing around 10 kilometers road per day. Today we are doing around 40 kilometers road per day. So obviously, there is a lot of work which is done behind the roads and railways, and again making the logistics and transit smoother and easier for the companies as well as the masses and the consumption for the consumption also. So there are multiple ways to play this theme. We are again playing through the building material side where we have onboarded companies, and again some bit of manufacturing companies are also participating in the theme. For example, we are holding a company from the manufacturing side, which were doing the renovation work for all the airports and then the railway stations. So there were large order book plays which are coming into picture because of that. So these themes could become a hunting ground for finding out the alpha opportunities for the investors. Now going forward, Prabhu, you can just move to the next slide. So lastly, we have to also focus on the profit pool, where the profit pool is coming into play, right? Where the profit is getting collected. So if you look at the last 10 years data, and if you look at the profit pool that been contributed by very small set of segment, right? For example, NBFCs, consumer, retail, and technology. So these segment itself contributes to 50% of the profit pool for the entire Nifty, right? And if you look at the ownership or the market capitalization contribution is roughly around 15% for that segment, which has again come down from 54% post FY20. So we expect that number to continue to go up in the future, and we expect the profit pool to further concentrate in those themes. So if anyone is looking to find out alpha opportunities like themes like financials, consumers, this could become a starting point for adding those names in the portfolio. So that would be all from my side. My colleague Vijay will discuss about the specific themes with all of you. So over to you, Vijay, now. Thank you.
Yeah, thank you, Prabhat, for detailed discussion. So now we will move on to the next section, which is the investment landscape. So here we will try to identify the sectors or the segments which will get disproportionate benefit once the economic progression happens in the next 5 to 6 years. So for that, what we have captured is the journey of the other developed economies such as US or European countries or Japan. So on the y-axis, we have captured the per capita GDP. So currently India is at 2.6K mark. And once the other countries, the previously developed countries in the previous decades, when they crossed this 2610 mark and started moving towards $3,000, $5,000 and eventually $8,000 mark, so there were certain segments which got the disproportionate benefit or which saw the accelerated growth. So some of the sectors were like real estate, credit, retail, manufacturing, wealth management, electronics, consumer durables, and recreational activities, and etc. So what normally happens is, so once the GDP per capita crosses 2.5K mark, income per capita also rises in proportion to the GDP per capita. Now people have more personal disposable income. So the necessities of people are being satisfied to a optimum level. And now they have excess cash. So they typically tend to spend behind consumer discretionary items such as branded apparels, jewelry, watches, and all other things. Also, now because of the strong income profile that they are getting from services side or the job side, they become confident in the future earnings or the future income, and they tend to purchase home rather than renting out. And because of that, we also see a boom in the building material space. And if we combine the increased demand on the consumer goods side or the discretionary side plus the building material side, we also see a boom in the manufacturing space at overall level because the production of these goods go up. And the excess cash that people are generating because of the higher income, they also tend to get accumulate some of the cash pile. So there is a natural need of wealth management as well for the excess cash that people are gathering from their income after spending them behind discretionary products, and they seek the help of the wealth managers or the financial advisor to manage that fund. This is how, with the economic progression, we crystallize the four big themes which we think have a strong tailwinds. First is the consumer discretionary, second is the building material, third is the manufacturing, and fourth is the wealth management from the finance side. Apart from that, there are also two themes that we think has a government push. Please move to the next section. Yeah. So if we talk about the other two things, which is the capital goods and RE theme, so there is a natural push from the government side to build infrastructure. And we see it happening like 12 to 14% kind of infra growth year over year for the next 4 to 5 years. So that will also propel the capital goods demand to 14 to 15% compounding for the next 5 years. And the energy transition, which is happening in India right now. So India is around 180 gigawatt of RE capacity, renewable energy capacity. And government is planning to move it to around 500 gigawatt by 2030. So almost 2.7x capacity will come online in next 6 years. But there is a huge opportunity to play in that theme as well. So these are the 6 investment themes we are focusing on. And of course, the some of the risks that we are watching and watchful are also like any kind of earnings slowdown, which can come from demand slowdown, maybe some geopolitical tensions, some kind of events happening on the global side. And the last one can be the inflation spikes, which can again come from, let's say, crude oil spike or some of the commodity inflation going up and those kind of stuff. These are the themes and the risks that we are watchful of. Now we will move on to the next section. We will focus on how we can identify the businesses from the segments that we have already highlighted. So for that, we will visit our RH Multibagger framework. So we have developed this framework around 6 years back, and we have been put in the test for the almost 6 years across the various strategies that we run. So basically, this framework has 2 legs. One is the growth leg and second is the value leg. In growth, what we typically focus on is on the earnings growth of the particular business. So we typically study and invest in the business whose earnings can compound, let's say 2x in the next 4 to 5 years of period. And also it should be more than the industry average. So let's say industry is growing at 14%. So we'll typically look at the business which is growing at, let's say, 18 or 17 to 18% kind of earnings growth. And when we are studying the business in detail, we also look for some of the competitive advantages of the particular business, like what are the sources of moats, so that we can foresee the consistency in earnings and the capital efficiency in the next 4 to 5 years. Second part is the valuation. So we don't buy business which are overvalued or which has no margin of safety. We'll typically buy a company which is trading to the discount to the peers and also the leader. So let's say if the industry is trading around 30x P, so we will typically go behind a business which is trading at, let's say, 20x P or the 15x P, which is reasonable discount to the leader, and which also gives us the opportunity of multiple re-rating in case the growth comes, like earning growth double. So this valuation arbitrage will also go down in the future. So let's say if the earnings is going up 20% for the next 4 years, so it will double the earnings. And if the valuation is growing from 20x P to 30x, so which is 1.5 times, and if we multiply 2 times earnings with 1.5x multiple rating, so we will get at least 3x return from a particular business. So that is how we study the business, and that is how we pick the business in our portfolio. So we typically hold around 25 to 30 different diversified names, which help us to protect from uncertain risk as well. And also at RH, we strongly believe that risk and return walk hands in hand. So we will visit the second part of our investment process, which is the risk management framework. So in that framework, there are 3 key pillars. So we typically see these 3 sources of risk can derail the story that we are picking from the valuation or, let's say, the earnings growth side. The first risk is the business risk. So we don't invest in the businesses which have unpredictable earnings, or let's say the lower margins, or let's say the margins are not consistent. Maybe the margins can be lower, but that should be the consistent. We don't like the inconsistent margins. Also, we don't pick the businesses which have narrow moats or the eroding competitive advantages, because it will destroy the capital efficiency over the years, which will also derate, or let's say which will lead to the multiple contraction in the stock price side as well. Second is the valuation risk. So we don't pick businesses which are trading at above average valuation, or let's say which is not which is having very low margin of safety if we compare it with the future earnings growth. And the third is the corporate governance risk. So we keep meeting a lot of promoters on day-to-day basis as well. So we typically avoid the promoters which are not transparent with the minority shareholders, because in the end, we are managing other people's money and we are the minority shareholder in the big business. So we don't typically go with the promoters which are not investor friendly, or let's say they are doing misallocation of capital, or they are not frugal with the capital efficiency part. And also they are not transparent in terms of, let's say, accepting the mistakes, or let's say giving the proper disclosure. So this is how we look at these 3 sources of risk, which has also protected us in the past from committing bigger or larger mistakes. And that is how we have built our strong investment process around the risk and return. Now we will move on to the next section where we will also focus on the outcomes of this whole process that we have been practicing for almost 6 years. So as we can see, we have captured some of the past multi-baggers. So KEI has been the fantastic business for us, and we have been holding it more than 5 years now. It has almost compounded the wealth for almost 14x, and also the trend which has done 7x. So these are the various businesses that has worked well for us. And there are also some of the businesses which did not work well for us. But because of the strong risk management process that we have highlighted, so we were able to exit before we lost the majority of capital. So this is how the process has helped us to deliver consistent superior risk-adjusted return from the various themes that we have picked up over the last 6 years. Now we will move on to the section where we'll focus like which are the themes which we can pick for the next 5 years. So as we have highlighted, as we have seen the 6 themes that we are focusing from the segment side. So we have tried to pick 5 themes in this valuation and earnings table, and we will discuss one of them to help you understand how we are picking up the future, let's say, multi-baggers in our humble opinion. So there are different segments that we have captured. If we take example of, let's say, the steel pipes that we are holding the business, it is trading at around 30x 1 year forward versus the industry leader at 60x P. It's almost a 50% discount. And so we can see the earnings growth happening around 2x in the next 4 to 5 years, and discount to converge it to maybe around 60x P once the re-rating happens, and 2 into 2 if we multiply, so somewhere around 4 or let's say 5x kind of return we can expect. Similarly, for a fashion retail company, the valuation metric is EV by EBITDA, because we have very high depreciation as percentage of the operating income. And typically the business is open too many stores in a short period of time. So P is not the correct valuation metric. So the business that we hold was trading around 11x EV by EBITDA, which was damn cheap in terms of valuation versus the industry peers, which is around 35x the industry multiple. So it was a steep discount, and we were expecting around 2 to 2.5x kind of earnings growth. And we are also expecting around 4 to 5x kind of upside in the same business as well. Similarly, wealth management and renewable energy and wires and cables are different themes that we have identified for the next 5 years. Now we will discuss the key business, one of the business of the fashion retail side. So this business, we picked it around somewhere around the first quarter of this calendar year 2024. The name is V2 Retail. And so basically this V2 Retail operates in the fashion retail segment for the whole family. And they operate around 127 stores across 100 cities. And typically they operate in the tier 2 and tier 3 cities. The average ASP, which is the average selling price, around 260 rupees, somewhere around in the Q1. So you can understand it's basically focusing on the value segment or the lower and middle class kind of lower middle kind of population of India. And the average bill is around 824 some mark. So it's also below 1,000 mark on the whole bill side. So their business is also has a private label of around 80% of their revenue. So they are currently, their private label is coming, they are planning to increase it to maybe 100% by the next 2 years, or maybe FY26 or 27. And when we picked this business, it was around 11x EV by EBITDA. And now somewhere it's around 22x EV by EBITDA 1 year forward. So the multiple rating has already happened 2.3x for us. And the EBITDA growth has happened around 1.15x in the last 4 months because of the 2 quarterly results. And we ended up delivering around 2.7x return in very short period of time. Again, this business is just for the educational purpose. Please do your own research or seek investment advisors advice before taking any call in this business. And coming to again to the V2 Retail, so management is trying to open around 40 to 50 stores in this year, and they are confident of the triple S, let's say, same store sales growth around healthy double digits for the year as well. And they are focusing on again tier 2 and tier 3, and they are expecting the margin to improve another 1% or 100 basis points in the upcoming 2 years. So this is how we have picked different businesses for the future as well. And we strongly believe like the investment process or the investment framework that we have been following will also keep generating the stable quality returns over the period. And the efforts that we have taken in the last 5 to 6 years, it is also visible in the performance of the portfolio that we have been talking in the previous webinars as well. Please move to the next section, Prabhu. So as we can see, the NAV series, which was around, let's say 100, which has gone up to around 321 as of this month, and versus the index of 232. The other important thing is the Sharpe and the trainer ratio, which is a risk-adjusted matrix, and also the beta. So our portfolio beta is lower than the industry beta, or let's say the index beta, and the risk-adjusted returns are also better than the indices. So we typically don't invest in companies like cyclicals or the, let's say, too much, let's say the companies which are having, let's say, order book play or the short-term plays. So we typically focus on keeping the quality small and mid-cap businesses in our portfolio, keeping the Sharpe and trainer ratio in check, so that we generate the superior risk-adjusted return in the long term. And finally, if we talk about the portfolio statistics, so our portfolio has compounded around 30% in the terms of revenue, 36% in the EBITDA, and 38% in the profit growth, which is reasonably higher than the BSE 500 TRI 500 companies average. And our capital efficiency and the return on equity is also around 50% higher than the underlying index. And that is also coming at the lower leverage versus the index itself, which is 0.65 versus the 0.8. So that is how we have created our quality portfolio in super value. And we strongly believe it can compound around 18 to 20% again for the next 4 to 5 years. So in conclusion, at RH, we strongly believe in the India growth story. And we think like quality small and mid-cap businesses are better placed to make multi-decadal wealth creation for the next 4 to 5 years. And if anyone wants to be with us in this journey, please feel free to join us. And thank you everyone for listening us patiently on this Saturday.